All right, welcome. Today, we're jumping straight into Chapter 5 of Trading Options for Dummies to really figure out what the market is actually doing. We're going to look at some tools that let you see past all the noise and understand the real story behind those wild mood swings. Okay, let's get into it.
So let's kick things off with a question that I'm pretty sure has driven every single one of us crazy at some point. You see the market just soaring, everything looks fantastic, and then, boom, out of nowhere, the whole thing just collapses. It feels like the market is sending these mixed signals that can be super costly if you read them wrong. So how do we actually get a clearer picture?
Well, the first secret to solving this whole puzzle is to stop staring at the big, flashy numbers, the Dow, the S&P 500, and to actually start looking under the hood. We've got to check the market's internal health, its actual heartbeat, to see if a rally is the real deal or if it's just faking it.
And that heartbeat has a name. It's called market breadth. Think about it like this. A genuinely strong rally isn't just about a few mega stocks dragging the index higher. No way. A healthy rally has tons of stocks participating, with gains spread all across the board. If you've only got a few generals leading the charge while the rest of the army is actually retreating, that is a huge sign of weakness. Breadth tells us how many soldiers are actually in the fight.
Now, the main tool we use to measure this is the Advanced Decline Line, or the AD line for short. And it's so beautifully simple. Every single day, you just take the number of stocks that went up, subtract the number that went down, and you get a number for the day. Then you just add that number to a running total. It's literally like an EKG for the market, giving us this constant read on its internal strength.
So, here's the absolute most important part. We're not looking for some magic number on the AD line. What we are looking for, the thing that really matters, is divergence. This is when the AD line starts to tell a different story than the major indexes. It's a massive warning sign that what you're hearing on the news isn't what's really happening underneath the surface.
And this right here is the classic red flag. So picture this. The NYSE Composite Index is pushing to new highs. Looks great, right? But at the same time, the AD line is quietly trending lower. What's that telling you? It's screaming that the rally is getting weak on the inside. It's being held up by just a handful of huge stocks, while most of the smaller ones are already heading south. That is a major, major warning that the trend is in big trouble. Okay, so let's move on to our second secret, which builds right on top of this. We've checked the market's physical health with breadth. Now, we need to check its psychological state. It's time to go from the market's mechanics to its mood by trying to figure out investor sentiment. And I think this slide does a great job of breaking these two things down. Market breadth, that's objective. It's just raw data, the hard numbers. It's physical reality. But market sentiment, that's totally subjective. It's all about the collective feeling of millions of traders, the fear, the greed, the whole psychological game. We're basically shifting from what the market is doing to what traders are feeling. And this quote from the book's author, Joe Dortez, just nails it. The market is not some logical machine, right? It's driven by us, by humans, making all sorts of emotional, sometimes irrational decisions. It zigs when everyone thinks it should zag, because human psychology is at its very core. And understanding that psychology is absolutely crucial. So, how in the world do you measure something as fuzzy as a mood? Well, we use some special tools that act as contrarian indicators. And all that means is that we're looking for those moments when the crowd gets way too extreme, either way too scared or way too greedy, because that's often the exact moment when things are about to flip. And a classic tool for this is the put/call ratio. It's like having a direct window into the market's brain. It's super simple. It just compares the number of bearish bets, which are put options, to the number of bullish bets, which are call options. It tells us plain and simple if the crowd is betting on the market to go up or to go down. Now, here's where that contrarian thinking really kicks in. When that put/call ratio gets super high, it means pretty much everyone is terrified. They're all betting on a big crash. But think about it. When pessimism is at an absolute peak, who's left to sell? Nobody. That widespread panic actually becomes a powerful, bullish signal, suggesting a market bottom could be right around the corner. And when we talk about sentiment, you just have to talk about fear. Because fear is such a stronger, more primal emotion than greed. Panic is just way more dramatic than excitement. It's why markets seem to fall off a cliff, but have to slowly climb a wall of worry. And that brings us to the ultimate fear indicator.
And that, of course, is the CBOE Volatility Index, which everybody knows as the VIX, or the fear gauge. Now, the VIX isn't measuring which way the market is headed. It's measuring how bumpy of a ride investors think they're in for over the next 30 days. When traders get scared, they rush to buy protection, and all that activity makes the VIX spike. When this number jumps, it is our clearest signal of pure panic in the market.
Yeah, and interpreting it is pretty straightforward. A high VIX, that means high fear, market panic. But what's just as important is the other side of the coin. A really, really low VIX can be a sign of investor complacency, a total lack of fear. And when nobody's worried about anything, well, that can be its own kind of warning sign that the market might be vulnerable to a shock.
Okay, now for what I think is the most important part. None of these tools, not breadth, not sentiment, should ever be used all by themselves. Their real power, their real magic, comes when you put them together, when you use them to confirm or contradict each other, to build a complete picture of what's going on.
And this is a perfect summary of our toolkit, right? You've got the AD line, checking the market's physical health. We're watching for divergence. Then you've got the PC ratio, reading this psychological mood. We're looking for those emotional extremes. And finally, the VIX, measuring raw fear. We're watching for those spikes of panic or those lulls of complacency. When you put them all together, you've got a really powerful diagnostic system.
So what are the big takeaways here? First, always look under the hood. Don't just take the headline indexes at face value. Second, remember the difference. Breadth is what the market is doing, sentiment is what it's feeling. And maybe most importantly, use these tools together. That's how you can really get a jump on spotting potential turning points before the rest of the crowd even sees them coming.
So I'll just leave you with this one last thought. Every single day, the market is broadcasting clues. It's telling you about its internal health, and it's telling you about its collective mood. The only question is, now that you know what to look for, are you listening?